Hello and welcome to the Gold Goats and Guns podcast for Thursday, April 7th, 2022. My name is Tom Luongo. We have a lot to talk about. It's episode 138, and I have the great pleasure of finally being able to, after about 3 years of trying to get her on the podcast, have Caitlin Long on, and we're going to talk Eurodollars, Bitcoin, and all sorts of stuff, and legal wranglings, and whatever we're allowed to talk about. And nothing we're not allowed to talk about. And I'm really glad to finally get Caitlin here. I know a lot of you have been wanting me to get her on the show, and it's just a matter of scheduling and all the rest of it, from what I understand. So Caitlin, welcome, and thank you for joining me this morning.
Hey, it's my pleasure. I have been following your work. I am a very curious person, and you are a true out-of-the-box thinker, and you've made me really think. And I especially appreciate that. We're not going to agree on everything, but that's part of the reason why it's fun. And so when we were going back and forth about prepping for this, I said, look, I'm going to be asking you some questions too. And so I'm hoping that this turns very much into a dialogue.
Absolutely. So just for people to remind everybody, like the first half of the podcast is for the guest. Like you talk about whatever you want, you set your argument however you want, and then the second half of it, that's when the criticisms of this podcast show up, because then I start taking over, because it becomes a conversation and a back and forth. And they're like, let's talk. I'm like, no. Part of this is I let the guests talk, and then we take that and we ruminate on it. We go from there. So, awesome. What I'm most interested in, and I know you and we talked about this in our show prep for this, that you wanted to discuss the Eurodollar system, and you wanted to discuss that. What I'm interested in is where is, that I feel like that the Fed is at war with the old European banking system, and then I think it's, at this point, it's kind of hard to argue with, really.
Right.
But the Fed is also engaged in a lot of practices that would seem like that theory or that thesis is incorrect. And that I know that you kind of sit at the epicenter of that. You're at the fulcrum of that with your Project Custodia Bank. So this is where I think we're going to have some disagreements, and I think where it's going to be good to go. So I put your argument on the table. Let's talk about that and tell me where you see that and your dealings with the Fed and or the federal government on these issues, and then we'll just riff off of it from there.
Yeah, that sounds great. So Eurodollars, I think probably most of your viewers know what they are. It is offshore US dollars. It's a misnomer, but it's US dollars that are created and transacted outside of the United States and outside of the direct regulatory purview of the US banking regulators. The history is that Russia, of course, is an oil producing country, and the first Eurodollars are traced back to the 1950s when during the Cold War, US banks were not willing to provide accounts for Russian account holders. And so, but of course, because OPEC said the oil market is dollar denominated, Russia received dollars and didn't have a place to put them. So the British banks stepped up, and that's the birth of the Eurodollar market. They started to provide non-sterling accounts. They started to provide dollar accounts, and thus a foreign exchange market was born. It expanded, of course, more gradually than most realize. It wasn't until the 80s when it started to become really large. And a lot of that happened because of the rise of the securities markets. There's some interesting history that it was during the Volcker Fed that the Fed did what I thought was a major change. And it was very subtle. It was not announced at the time. You had to pour through the minutes of the Fed meetings at the time to figure out that they changed in 1983, the Fed changed its target from targeting the quantity of money to targeting the price of money. So it switched over from targeting M2 growth, for those who have an economics background, to targeting the Fed funds rate. And ever since then, the Fed, of course, has continued to target the price of money, the interest rate. And what happened back then is that the keys to the proverbial kingdom were handed over to Wall Street. And that is when you started to see the securities markets take off. And Greenspan, of course, elevated that, and the rest is history. But we started to see the offshore banks in the so-called Eurodollar market also really expand through securities. And arguably what also happened is that US Treasuries became the base money of the shadow banking system in beginning in the 1980s and especially exploding in the 90s and into the 2008 financial crisis. And so that's some really important history that essentially lays out we've had a parallel system in this Eurodollar market for decades, and it exploded in size in the knots, and then exploded in the 2008 financial crisis. And then the Fed had to take all of those liabilities onto its balance sheet. The Fed's balance sheet prior to the financial crisis was 850.
Right, 850 billion, maybe. And
exactly.
We were complaining about it then, right?
We were, and then it was after the financial crisis. It was up to 3 trillion, and then it topped 9 trillion. Most recently, of course, this whole notion that the Fed is going to unwind QE, of course, has never been accurate. Although it has been part of what the Fed has done to sort of keep its credibility, to say, well, we're going to engage in quantitative tightening, even though, and this is one of the interesting things I'd like to debate you on, because your point has been so interesting that you can taper a Ponzi. There's a strong thread out there that you can't taper a Ponzi, and you have made me think about can you taper a Ponzi? So let's go there, because you have such an interesting thought about that.
Because I wrote the article about a year ago, where I said, something about Ponzi schemes and the limits of the QE or whatever it was. I can't remember the name of the article. I'll link it in the show notes. I'll find it on my blog. I'll link it in the show notes. And the point being is that, if you think of it this way, we saw it even in the stable coin market, right? With, I looked at FTX as kind of a Ponzi Hoover, right? It was just a vacuum that just sucked up all the smaller Ponzi's into the larger Ponzi to then try and compete with the biggest Ponzi in the world, which is the Federal Reserve. Okay. The Federal Reserve runs the largest Ponzi scheme in the world. Well, if FTX could do it in the crypto markets, then why can't the Fed do the same thing in the currency and treasury markets? Now, there's a couple of, and then that's the short term. That's like phase A of the operation. Well, the Fed starts to contract credit. It's going to implode credit assets. We saw Bernanke do this in 2007, and and all the Austrians were like, "This is going to be bad." This is why Peter Schiff is famous, because he said, and all that money had flowed into U.S. housing, and then that collapsed, and and all that stuff. And and Peter wasn't wrong then, but he's not right today, because he's still running the same script in his head. Yeah. But it's based on that same base. I'm just taking that argument and going one step further, saying, look, if you're the largest Ponzi scheme in the world, you can taper your Ponzi by 5% or 10%, and you'll collapse everybody else, because they're all more leveraged than you are. And leverage, what giveth on the way up, takes away twice or 3 times as fast on the way down.
Correct.
So all those assets, which, when you looked at FTX, what they were doing was they were rolling the cash, the actual cash, from all of those other Ponzi schemes onto their balance sheet, and then issuing magic beans as the new collateral, right? But they took all the money. Yeah. Well, that's what the Fed's doing now. And they're doing that to the other central banks, the ones who have declared war against the Fed itself. Yeah. So, and so the Eurodollar system, as we've come to understand it, thanks to work by guys like Jeff Snyder, whom I today have a problem with, because he's sticking with an old model, in my mind, an old intellectual model, which is that the Eurodollar system is something that was necessary to create to get around the central planning of the Bretton Woods era. And that I fundamentally disagree with. I think it was the next iteration of how Bretton Woods allowed for the levering up of the monetary system.
It's still centrally
planned. In order to decouple money from real work. Yeah. Because that's ultimately, when we Austrians talk about money, we talk about it in terms of Mises' regression theorem and it being a commodity, right? So it's the most liquid of commodities that trades at par with no discount due to time, right? So that's ultimately the definition of money from a Misesian point of view, right? So now let's take that one step further. What are the, and you're free to do this, and what are the shitbags that have built this world done? They've always tried to unmoor money from the opportunity cost of creating new monetary units. Why? Because they get to, through the Cantillon effect, get to spend that money before we realize what the price has changed for money and the quantity of money has changed. And therefore they get to buy tomorrow's assets at yesterday's prices with today's money. That is the Eurodollar system writ large. And it only gets worse if the Fed, the issuer of Eurodollars, goes to the zero bound. Then the Ponzi can go to infinity.
Absolutely. And we saw it almost do that. Right.
Exactly.
Right.
And so that's actually what they're trying to do now. So this is the fundamental argument, and I'm not saying the Fed can taper this Ponzi without pain. I'm not saying that the Fed
You have been very clear on that. Yeah. Yeah.
So, and I think I think what we should be doing is looking at it from that point of view. Go, well, if the Fed is actually doing this, which is clear they are, we're at 5%. Mm-hmm. They're still doing quantitative tightening in the background. They're still
balance sheet shrunk.
Still doing it
yesterday.
And put some temporary. And so after Silicon Valley Bank and Credit Suisse, they put some temporary liquidity on their balance sheet, like the Fed is supposed to do. Whether you like the Fed or you don't like the Fed, that's the Fed's primary job: keep the banking system liquefied, and and deal with and be the lender of last resort to deal with the time mismatches that exist within the overnight lending markets. That's its job. Like it or not, doesn't matter. You don't have to like it. We're not here to talk philosophy. We're here talking what's here. Right?
Yeah.
There we are. So once we do that, like, okay, now, well, who's the most vulnerable Ponzi on the planet right now?
It's
in this situation.
It's Europe. Yeah. So that is so interesting, because you were onto something that we all knew about in the financial markets when the Fed started to push the secured overnight funding rate as the rate that prices floating rate debt. Most folks don't understand, because the stock market gets so much coverage. The bond market it dwarfs the stock market in size. It's far more important. And a lot of debt is floating rate. And it had always been priced in LIBOR. And so when I was working on Wall Street, I spent a lot of time with the exotic interest rates trader. And during the 2008 financial crisis, boy, did he help me really understand how there were plumbing issues, because back then everybody thought LIBOR was a risk-free rate. And then what ended up happening in 2008 is that we realized not only is it not a risk-free rate, okay, the TED spread, the difference between T-bills and the short-term money market rates exploded. And what that was attributable to was the credit risk, the default risk of the banks. But it is a London-based rate, okay? The London interbank offer rate is what LIBOR is, okay? So the Fed has been moving us away from LIBOR to SOFR. What's the significance of that? Well, in capital markets terms, SOFR is a secured overnight rate. And LIBOR is unsecured. Okay, so the SOFR rates are tied to collateral. The general collateral is typically a government guaranteed short-term instrument like a T-bill, and the unsecured, of course, are going to be tied to the default risk of the banks. And at the time, there was only one U.S. bank that was part of that LIBOR panel. Okay, so where we're leading is that what happened in the 2008 financial crisis, which so few people talk about, and you really made me think through, is that 2008 was the onshoring of these over-leveraged European banks' credit risk into the U.S. real economy. And the mechanism was through LIBOR. And so the Fed was 100% right to try to push the US dollar floating rate interest rate market away from LIBOR to SOFR, which it controls, which is a domestic market and is tied to T-bills as collateral. And the punchline is that was designed to kneecap the Eurodollar market, over which the Fed had very little control. Fire away.
Yeah, no, you're absolutely right. Actually, I'll be honest with you, Clayton. Thank you for that, because you said a couple of things in there that I haven't been able to articulate. I intuitively got it, but you said it in such a way by reminding everybody that SOFR is tied now to the T-bill rate as opposed to LIBOR, which is tied. And there's a couple of things in there. I'm going to go back and listen to that section of the podcast again so that I make sure that I get it right, so that I can add that to my talking point. So honestly, well done. Thank you. So
we're helping each other think this through.
Absolutely.
It's complicated stuff, but it's really big.
I tell people all the time, I LARP as a bond guy. Like, I didn't know anything about this stuff. Like, and I'll be honest with you, the whole SOFR versus LIBOR thing was put into my head by a patron who's a banker. And he texted me one day and he's like, dude, you really need to think about SOFR. And I'm like, and then he sent me an nearly incomprehensible text, right? With all this inside baseball that I'm like, trying to keep up with. It was like reading Zero Hedge in 2008, right? Or 2009, right?
Right.
Okay,
Yeah.
I'm going to say this back to you in like normal terms in English, and you tell me if I'm wrong. And he went, I think you got it. I'm like, okay, I'm going to think about this for a while. And then we started to like work through what are the mechanisms and the incentives for SOFR. And then you go over the history of it, and you realize that SOFR was on the books theoretically at the Fed in 2008. And that Geithner and Obama put the kibosh on it until Trump was elected, put Mnuchin in charge of Treasury, and Powell was installed at the Fed, and John Williams was installed at the New York Fed, because Williams is the architect of SOFR. Okay, so this is the so when you really go back over it, and then you think, and then you listen to Danielle DiMartino's Booth's book about Yellen and her allowing the 2008 financial crisis to germinate through Countrywide and IndyMac and all these terrible California lenders.
Right. Yep. She was at the San Francisco Fed back then. Yep.
She was the San Francisco Fed back then. Then she became Fed chair. And for how long did Yellen put off raising interest rates?
Yeah.
She put it off like for 2.5 years.
Yeah.
Well beyond what she should have.
Right.
Clearly, because Yellen has always been a Davos.
Well,
she's always
a
been in the tank for
monetary
Davos. She's a commie. I'm sorry. That's who she is.
She's a modern monetary theory proponent, and she blew Congress's mind in her most recent Senate finance testimony, where she said, I'll paraphrase her, the debt doesn't matter. And the senators just had no idea what she was talking about because it was nonsensical. Well, you and I both recognize I'm somebody who's done a very deep dive across a lot of different schools of economic thought, including Austrian on the one end to modern monetary theory on the other. And I understand the way the modern monetary theory proponents think. The issue that they have, the biggest blind spot that anyone on that side, that part of the spectrum of the economic schools of thought, is that they think the balance sheets don't matter. And in the short term, the balance sheets don't matter until that's the only thing that matters. Okay. And the Austrians are over there screaming, the balance sheet matters, and being portrayed as Cassandras. Exactly. And in fact, actually, in the end, guess what? The balance sheet really matters, right? We've learned that with the bank runs that just occurred. And ultimately, a fiat currency is just a reflection of the income producing assets in the country. And as you keep loading up more debt on the income producing assets, ultimately there will not be enough income or cash flow to service the debt. And that's when we move to a new regime. Okay. So
and that's Mises's crack up bone.
It is. But I will say I've been critical of the Austrians because the Austrians have always said we are headed for hyperinflation, right? They said it in 1971, they said it in 2008, and they were wrong. What happened? To me, that's the more interesting question. And this is where, looking at the modern monetary theory proponents, you really have to have a good argument for, in practice, why they have appeared to be right in the short term. And the answer is that we still had balance sheet in the United States. We still had debt capacity that we could load up all this debt. And we have for 50 years loaded up all this debt. I did a presentation in San Francisco to a Mises group back in, I think, 2018, maybe 2019, about the history of the US economy. We were a equity financed economy until 1968. What does that mean? It meant that it didn't mean there was no debt. I'm not with the sort of, folks that think debt is bad. No, right. I will rail against leverage, but what do I mean when I say leverage? I mean leverage in excess of 1-to-1. This is, to your point, to put it in the Misesian terminology, this is circulation credit instead of commodity credit. Circulation credit is debt that arises out of thin air, that's not backed by anything that was actually previously produced. Commodity credit is debt that was created out of something that was previously produced. So taking that philosophy and putting it to math, all the debt that was issued in US dollars up until 1968 was roughly equal to the cumulative amount of savings in the US economy. Okay.
Right.
So that's
So
what
the
I
pool,
mean when
so
we say,
in the so in Austrian terms, the pool of real savings was backing on a 100%. We had
correct,
100% reserve banking in effect
correct, correct,
because the pool of real savings in Austrian
correct.
terms equaled
Yep.
the amount of debt, and there was no more than one claim for a debt dollar that there was for credit
Yep.
dollar that there was for an actual dollar,
And
which is perfectly
periodically,
reasonable.
correct. And you'd periodically see inflation get ahead of itself. And then the Fed, because the only place where credit was created was the traditional banking system. So
Right.
you did have fractional reserve banking, but
Sure.
it literally, it used to be almost a one-for-one relationship when the Fed injected monetary base, the high-powered money, Fed injected reserves into the banking system. Within 6 months, CPI would go up, right? So
Right.
it was actually a relatively easy thing to predict. And when CPI went up, then the Fed would pull back on the quantity of money. Remember, they were back then targeting the quantity of money. It was an easier thing to manage, and it was very transparent, pretty close to one. And so ultimately, therefore, prior to 1968, the U.S. had really no circulation credit on the economy. Every dollar of debt that was issued was commodity credit. Then what happened? Guns and butter came along. Okay. And then we started cheating, and it resulted in the French calling their gold back and Nixon closing the gold window. But what's fascinating is if you look at the debt growth, and when I say debt, what I'm looking at specifically is non-financial sector debt. A lot of people make this mistake in looking at total debt. The financial sector just circulates debt into the real economy. So you're double counting the debt. If you look at total debt, what you really need to be focused on is ultimately the non-financial sector debt, because that's where the real debt is in the economy. Everything that goes through the financial system is just circulated out. It's just an intermediary out to the real economy. Okay.
Right.
So in the debt growth in the 1970s was not that high. Yes, we broke the tether. And that's what was special about gold. It was just a good tether on debt growth. Okay. Right. There's otherwise nothing special about gold. I know that'll make people mad, but it sounds like you agree with that statement. Gold was just a tether on debt growth. That's it.
Sure. That's it.
And yeah, exactly. And so, and it because it happened to grow at about the same rate as the population, it kept inflation under check because it kept debt growth under check. But in the 70s, of course, we obviously had inflation. And you can see the debt growth, the non-financial sector debt growth start to accelerate, but it was generally under control. It wasn't until the 90s when it started to get out of control. And again, that ties to the rise of the Eurodollar market in spades, because you started to see offshore US dollar creation explode through the mechanism of the securities markets. Okay, and here's where the Austrians missed it. They were still thinking in Rothbardian terms, right? Rothbard died in 1994. If he were around, I think he would have understood all this and pushed all the Austrians to realize.
Gary North understood a lot of this stuff.
He did. Yes.
So back in like 2008, in that whole period, I started discounting certain Austrians, and I kept who's making more sense here? And North was the guy who said, look, Bernanke has created all this money, but it's not circulating, so it doesn't matter.
Correct. So and it was a swap.
That interest,
He's right.
Interest on interest, correct. And the interest on excess reserves was the only thing you needed to understand. I remember sitting at a conference that we put on at Newsmax in 2014, and we were sitting there we were all arguing, why haven't we had inflation yet? Blah blah blah. And I was sitting next to my friend who showed up, and I took a cocktail napkin, and while they're arguing, and I just wrote 4 letters, IOER, and then passed it to her. I'm like, that's it. And that was North's analysis then. He was right then. He's right today. And so using that as a framework, you can see how the RRP facility is being used to sterilize the CARES Act.
Sterilization. It's a swap. That's all it is. So because we just threw a bunch of terminology at folks.
That's okay. That's okay. This is a fairly high level podcast when it comes to this. So it's okay. We don't have to, but if you want to, we go ahead and define terms.
Well, I think it is important because so many Austrians have missed this, right? They think when the Fed's balance sheet expands that it's automatically inflationary. The answer is no, because there's a huge contraction of credit that goes on that causes the Fed to have to expand its balance sheet, and they are filling the hole. What do I mean by that? The non-financial sector debt growth, which by the way, that's the critical number. in order to keep the economy inflated, the Fed has to ensure that credit is continuing to grow 4 or 5% a year. Last year, I looked at it, non-financial sector debt grew 6.5% per year. We had booming securities markets. Just that little bit of excess over the 4 to 5% growth caused booming securities markets. Okay. And bubble in securities markets. But that's the most important number. And if you look at it, it actually has been incredibly steady. If you look at a growth at a chart of non-financial sector debt in the United States, you cannot tell who was when a Republican was in charge versus when a Democrat was in charge. Now, where the growth actually comes from will move from time to time. Sometimes it's more government debt. Sometimes it's more private sector debt. Sometimes it's the Fed issuing more money. Okay. But in aggregate, this all has to keep growing 4 to 5% a year in order to keep an incredible deflation at bay. So when you start to see that debt is not growing at 4 to 5% per year, what that's going to tell you is that you're going to start to see problems in the financial sector and start to see banks having bank runs, or start to see the Eurodollar market having a shortage of collateral, which is exactly the environment we're in right now, right? And what does the Fed do? It expands its balance sheet to keep non-financial sector debt growing at 4 to 5% a year. Except it's not as easy for the Fed to control all this as it was in the 70s, because back then, in the 60s and 70s, it literally, as we said, they would inject reserves, and within 6 months it would show up in CPI, because back then banks never sat on excess reserves. There were Fed funds trading desks where if a bank had excess reserves, they would sell those excess reserves every day to another bank. Okay. They literally had no excess reserves. They were fully loaned out. Okay. Yep. Now there's all this mishmash of sterilization that the Fed has had to effect, in part because of the rise of the Eurodollar market. Back to where we started, the Fed has not had control over the total amount of US dollar credit that goes to the non-financial sector economy, because the London banks were in charge of it.
Yep. So now let's bring it all the way back around. And this is what gets into, quote unquote, Tom Luongo's thesis of everything, the theory of everything. That a guy named Mark Walk writes all the time, which I find really, it's kind of embarrassing, actually. It's humbling, but in so many ways. But which is that SOFR, now putting SOFR on the table, you take the price of dollars out of the hands of London and the Eurodollar markets, and you put them back on the Fed's balance sheet.
Correct.
You put them back under the purview of the Fed and the U.S. financial markets. And to anybody listening to this thinking, well, yeah, why wouldn't Wall Street want to do this? Right? Why would Wall Street? I mean this sincerely, in that when there's a transition period that's going to be ugly for everybody.
Yep.
Okay.
And we're in it.
And we're in it right now. Yeah. But on the other side, it's either Wall Street keeps doing this, and then they wind up under the purview of and the control of the modern monetary theorists, and they don't have a business, or they have to take a bite out of the shit sandwich just like everybody else does, which is kind of what the Bank Term Funding Program did by making them liable for FDIC going bankrupt.
Yes.
Okay.
We'll come back and talk about that. Yeah.
I mean, look, the Bank Term Funding Program isn't perfect, but it's a better solution. What it clearly says is that we want to bring all the U.S. treasuries that are offshore, that are coming back this way anyway, because half the world's de-dollarizing. 3/4 of the world's population is de-dollarizing as we speak.
Yes.
What's the Fed going to do? They have to get those treasuries back on shore, and we have to become Japan. The American saver has to become Mrs. Watanabe.
Yes.
Okay. Well, and that's what we need to do. And I'm looking at the way the Fed has been acting and everything that they put in place since SOFR became a pilot project under Powell, with the interregnum of COVID, which was absolutely an attempt to destroy the Fed's credibility once and for all, and install Lael Brainerd, the ultimate MMTer, as the FOMC chairperson, chairwoman, whatever, that was the point. And then Biden put Yellen in charge of Treasury in order to have policy confluence between the Fed and Treasury. And that what we have is the exact opposite, because Yellen's an MMTer, Powell is private equity Powell, and has been the biggest hawk on the Federal Reserve Board going back to 2007, other than Richard Fisher.
He doesn't, this. So, all right, now let's throw in
Sure.
up until this point, we've probably agreed on a lot of things. Let's
Mhm.
throw in some curveballs
Sure.
because Powell has done some things that would indicate that that's not necessarily his philosophy.
Mhm.
Okay. And we don't know the politics. There are clearly politics going on behind the scenes. I mean, look what happened to Custodia, right? There was a coordinated announcement with the White House on the morning that Custodia was denied. And Washington, D.C. is a sieve. People came forward. We know exactly what happened. Why did Powell coordinate with the White House to deny Custodia? I don't know the answer to that, but here's an interesting question. Custodia, of course, was just the tip of the spear. We know that now. Back then, it was confusing because it was such a turnabout. And it's now out there, and I can talk publicly because the Fed released this 86-page order explaining why it denied Custodia and put a record amount of confidential supervisory information out there. It is criminal for a bank to disclose confidential supervisory information, but the Fed went ahead and disclosed it. So we can talk a lot about it.
Okay.
You can see that Custodia was working with the Fed all the way up until something changed suddenly in January. And so what happened this year, right? We now know is that there was this coordinated attempt to shove crypto into the shadows. Okay. It started with Custodia. Why they proverbially shot the stallion to scatter the herd is an interesting question, because it does seem to go away from your theory that what Powell's trying to do is get control of the Eurodollar market. Now, one of the things vis-a-vis crypto that he has done is make moves against stablecoins. What are stablecoins? Stablecoins are non-bank US dollars, i.e. Eurodollars. Okay. Yeah. But here's the interesting question. It makes it seem like maybe this wasn't his philosophy. Why did he not greenlight a company like Custodia that would have brought all of that into M1? Because Custodia as a bank issuing a tokenized US dollar, that's M1. As a non-bank issuing a tokenized US dollar, that's M3.
Right.
Over to you.
It is a good question. And you and I discussed this when I first asked you to come on the show, and while everything was happening with Silicon Valley Bank, you and I were Twitter DMing back and forth, and we had a wonderful conversation. We were challenging each other back and forth. And I never really gave you a good answer for that. And I still don't have a good answer for you for that, other than it doesn't feel like this is the right moment for that. Like the Fed is under, if you really look at it, just like from the macro, like the game board perspective, if I'm the player at the table, I say to myself, what they're doing is perfectly reasonable, but I can't legitimize this right now, because if I do, I've got to gain credibility back over my own markets. And there's probably deals being made behind the scenes to even keep any of this in power. And then you've got what Wall Street would want. Do you think Wall Street wants the competition of having you doing this? Like when clearly Jamie Dimon would like to have that same function, right?
Oh, well, he already does with JPM
right.
coin, right? But here's the funny thing. Remember, I came from Wall Street, and I'm still very tied into some of the powers that you would be amazed. I can't share a lot, but you'd be amazed at how much Wall Street was supporting what we were doing.
So now that becomes very interesting as to what the situation is. And again, I don't have a good answer for you. And Powell is not, I don't consider Powell any kind of white shining knight. I mean, again, the Fed is acting in its own best interest to survive this situation, what that is happening right now, which is that they are under unprecedented assault from foreign powers, both from Europe and from China, and even to a lesser extent from the Russians, who are, in my opinion, perfectly legitimized in attacking the United States because of the way we've treated them. But as far as the Europeans are concerned, they're acting like we just want our colonies back. They're acting like old colonialist, mercantilist powers. That to me is anathema, and it's far worse than the Chinese and far worse than the Russians, who will be happy to sit down and negotiate some kind of settlement and then fight it out 10, 20 years, fight out the whole thing 20 years from now. The Europeans, on the other hand, are looking at 2025 and going, oh, we're dead if we don't.
That's where I do agree with you, is that Europe wants its power back, and Europe had control over the US banking system through the LIBOR market, right? Because of the way the London banks, the power of the London banks, and most of the LIBOR banks on the panel in 2008 were not actually UK based. They were continent based. But this is interesting because the issue with crypto is that the Biden administration, there's an anti-crypto wing, which is actually, let me step back. I don't want to politicize this, and I reject the politicization of Custodia's application by the White House because this is not political. It does not cut across traditional Republican Democrat circles, okay? Because you really do have strange bedfellows here. Elizabeth Warren and Bernie Sanders have said some things with which the libertarians are agreeing, okay? They diagnose the problem as the same problem. They might have different solutions. Okay. So, and you have, Lummis Gillibrand working on a bill to try to legitimize stable coins. Okay.
Right.
But what's fascinating about the politicization of this is that that ultimately this technology is really powerful and it's not going away. I know because of moles that we have in Washington, and again, Washington is a sieve, so we know all of these things with pretty high confidence because we're getting them, if not first and second hand, or the third hand stuff keeps being repeated. Right? There is an anti-crypto wing of the Biden administration that is also pretty much anti-tech. Okay. And the same thing was true in the Trump administration. This is why I'm so adamant that this is not political. There are factions in both presidencies that were pro and anti. And the pro wing, we know exactly who it is and what happened and how and why they were able to make the move that they did. Why the Fed went along is still something I don't know the answer to. And I've actually openly asked people to reporters to go digging. Why did they coordinate with the White House in this very anti-stablecoin, anti-crypto move? Was it because, and some people thought it was because the Fed wanted to issue a CBDC, and multiple people, but hang on, multiple people pointed out because Custodia has the patent on tokenizing bank deposits, which we were granted in July of last year. So a U.S. bank to take in a U.S. dollar and issue a token on a blockchain for that US dollar. That is a patent that Custodia was granted in July. Okay, so part of the reason why some folks were positing that a CBDC might have come into play vis-a-vis the Custodia application is because, as you know, within the Federal Reserve System, there are 12 regional reserve banks. That's where the balance sheet is. People talk about the Fed's balance sheet. It's actually the amalgamation of those 12 reserve banks' balance sheets. That's where the money gets issued, and they are legally owned by their members. The shares of the 12 Federal Reserve banks are owned by member banks. Okay. So therefore, there is a very legitimate question whether they have to comply with patent law. And if a private bank has a patent and they try to violate the patent, are they subject to it? Okay. So this is where a lot of folks were going with why did they pick on, shoot the proverbial bazooka at a bunny rabbit, right? Custodia wasn't even taking external deposits at the time, right? Why did they go after Custodia as opposed to going after, say, Tether first, right? Or going after Coinbase first, which ultimately they did. They've gone through the entire industry now, and pretty much every intermediary, with the exception of a couple that I'm hearing on the chopping block too, they're not done yet. They are trying to shove this entire industry offshore. Now, let's come back to the theme of this discussion, which is Eurodollars. If you're shoving this offshore, what are you doing vis-a-vis the Fed? You're actually ceding control of the whole thing to forces that you can't control. Okay. And so it's fascinating to see who's picking all this up. Some countries like Singapore, Hong Kong is now picking it all up and saying we're welcoming it into our shores. Switzerland, right? So Europe with MiCA is grabbing all this. So why is the Fed shoving this all into the shadows? I know there are some folks who think there's nothing backing Bitcoin. Therefore, its value should go to zero. And if we shut off the US dollar spigot to Bitcoin, then its value will go to zero. Well, I think they've obviously been proven dead wrong. Okay. Right. Because Bitcoin's price has gone up in the face of what they've done. It was the best performing asset in the first quarter. Okay. So that faction that thought it's just going to go away, it's going to die on the vine, they've just been proven wrong for the umpteenth time. I love There's a website, 99bitcoins.com, that actually chronicles the obituaries for Bitcoin. And last I looked, there were 467 obituaries for Bitcoin, and it's fantastic. I love going back and looking at all those. I mean, those people are just broken clocks, and they're just dead wrong. Bitcoin, of course, is not going to zero. Why? It's all subjective. It doesn't need to be backed by anything. And you and I made that logical leap a long time ago. It's all a confidence game.
Well, it doesn't. It is. It's backed by the immutability of math and the opportunity cost of diverting human activity to generating electricity to solving math problems, as opposed to anything else. And it's the opportunity cost of creating new monetary units that forms the basis for the commodity basis for becoming
for
money.
Why it has value. Yeah.
Look, it's just simply put, in July of 2010 on the Bitcoin forums, I argued Mises' regression and Bitcoin.
Yes.
Okay.
Yes.
And then I explained it all to the Lou Rockwell guys in private emails behind the scenes the rest of that summer. Because they were all on it's just ephemera and yada yada.
Right,
like,
exactly.
No. I'm like, dude, it's anything can have token as long as there's opportunity cost in creating a new monetary unit. That's it. That's all that matters. It doesn't matter if you're digging it out of a hole in the ground or you're backing it with electricity and math.
Yeah.
Gold is no less tokenized diesel fuel for all intents and purposes. Then Bitcoin is tokenized electricity. Then aluminum is congealed electricity.
But see,
it's the same thing.
I used to make that same statement, but I've gone to an even more ephemeral level, which is, you're right. It's tokenized electricity. That's implying that there is something real behind it, though. I reject the notion that you even need that. It is all subjective. It is all subjective. It's all a confidence game. Yeah.
I'll go one step further. When I originally did this, I didn't even go down the commodity route by saying any of that stuff. I just said, look, do encrypted packets on the internet have value?
It depends.
Well, if they're your latest text to your boyfriend that you want to get together tonight for a hookup and some Netflix and chill, no, not necessarily. But if it's IBM's quarterly reports and supply chain information for Apple, well, then yes. So why is one encrypted packet of information have value and another one does not?
Correct. Right. And then
that was my argument in 2010.
Unforgeable costliness, right? To use Nick Szabo's phrase. So, okay, so we're in agreement on Bitcoin. Now let's come back to crypto vis-a-vis the Fed. Okay, there was the group that thought it was going to go to zero. They've been proven wrong. Now we're back to, okay, these things are Eurodollars, and specifically stable coins are Eurodollars. They've just shoved this whole thing into the shadows. Now, the White House came out with a statement, another statement yesterday. They're very anti-crypto, and the neocons are shining through. They want to control everything. You are presumed a terrorist until you prove yourself innocent. Okay, they want a surveillance state, both for, and this is, Yellen's been very open about this, for tax collection purposes, and then also the foreign policy folks want to surveil every financial transaction. Okay. And ironically, here's the funny thing. Go back and look at the evolution of the Bank Secrecy Act. It's always been the Republicans that have been expanding it. It's not been the Democrats. It's not what people intuitively think, because they see the Biden administration really, really grabbing onto that. But it was Trump who signed the travel rule into existence. It was Bush who signed the Patriot Act, right? And then go back to the original, I believe it was Nixon who signed the original Bank Secrecy Act, which back then was all about, again, money laundering and control of dollars vis-a-vis the closing of the gold window. But we're getting a little bit off topic here. Let's bring it back to, why is the Fed behaving the way they're behaving vis-a-vis crypto? Because crypto are ultimately Eurodollars. So why is it that they would want it in the regulatory perimeter? Fire away.
I don't know, but I can tell you that I think Powell's been very clear that he has no problem with Bitcoin. He sees Bitcoin as a commodity. The Fed has been very clear that they think Bitcoin is a commodity, but they are, I think, I don't know. What you just traced is really very interesting, and I don't have a good answer for you. Okay. But what I can tell you is that there must still be some argument here that they can control the issuance of stable coins, even if it's shoved off of the banking system, as opposed to was what you're doing at Custodia, whether they understand it or they don't understand it. Because look, the Fed in 2008 didn't understand the concept of the shadow banking system.
Correct.
It had to be explained to them by Zoltan
Correct.
Pozar. So
Yeah.
they may not have gotten, it might not have gotten all the way through their head that, they've just been given the order from Powell, no stable coins.
Yeah,
Bitcoin's fine,
they had a
stable
friendly in
coins
their
bad,
midst that
and that's
didn't realize
as
it.
deep as it goes.
Yeah, yeah,
and
yeah.
that bureaucratic incompetence, which we know is deep in the Fed's culture, may just be that, and that it's just going to take another round. And then once the Fed has gotten control over Europe's attempt to destroy it, and we get past the Biden administration, that if we get past the Biden administration, which I'm not even convinced of that anymore, but that's another topic here, which is once we get past that, then the Fed will be able to allow for the validation of Bitcoin as a financial asset, as a real financial asset, and a real, I think, backing asset. I have a patron. I think I told you this, but I don't remember he's a quant. He works in the banking sector. Young guy, really fucking smart. Like, I think he's really smart, and I'm a smart guy, and you're a smart gal, and like this guy makes me really think. And because this is what he does, and he's like, Tom, I was going over the Bitcoin trade and one other market, and I was like, he's like, and when he like wrote this massive post on our private Slack forum along with charts, and he's like, look at the overlay. It already looks like they're using Bitcoin to stabilize and collateralize the SOFR market. And
you mentioned that, yeah.
And they may not be. Fed may not be able to even allow that to come to the light of day at this point. Maybe that's the answer. I'm just throwing this stuff out there. And I've talked about this in other interviews. So this is nothing new here. We've been talking about this, in my community, on and off for a few months now, trying to workshop this thing. Like, maybe that's part of it, that the Fed can't come out at this point because they know that if that comes out, right, and if it comes out that the Fed actually owns Tether, or at least owns the reserves that Tether is based on, in order to keep Bitcoin liquid. Because if Bitcoin's liquefying, just helping to liquefy and collateralize the SOFR market, and Bitcoin still needs something to trade against, right? I know I can see your face.
Yeah, right? I'm a skeptic.
yeah, I know you're a big skeptic on this. But if those two things are true, and I'm not saying they are, but if they are,
no one
then
can
it makes
prove
sense
it,
to
right?
just to leave it laying in the background while they go after bigger fish.
Yeah.
And now they have, because Bitcoin still needs to be liquefied to trade against something, but it can't trade directly against dollars at this moment in time until it's allowed to trade in the U.S. banking system. You got Gary Gensler refusing to allow one Bitcoin settled futures and a real Bitcoin holding ETF.
Yeah.
And there's nothing the Fed can do about that either. And I think those two things may actually also answer part of the question as to why that maybe the Fed would be happy to have Bitcoin as a bearer asset that would be allowed to, as tier one capital, for lack of a better term. But they can't at this point because they don't have control in Washington to get that done. Because Gensler is absolutely, like, him and Yellen are just stonewalling everything. I mean,
right.
just popped into my head, Caitlin, so I'm just vamping at this point.
Yeah. No, I mean, the honest truth is we don't know the answer, right? We don't know the answer. I haven't looked at the other assets on the Fed's balance sheet for quite some time, but it's in the hundreds of billions of dollars. We don't know what's in there. Right. And it hasn't been audited, so we don't really know what's in there, right? There's no disclosure about what's in the other assets, how much real estate is in there, how much. I mean, we know what the gold is carried at book value. It's not valued at market, but there are other assets, and it's a huge number, and who knows what it is? Well, we may never know the answer to that. But I don't believe. I get your point. What happens, and the quants will look at this in financial markets and spot correlations that are purely spurious, and they might work as a great trading strategy. So to your point, there may very well be an interesting overlay where Bitcoin is tracking with SOFR, but that doesn't mean that exactly that it could be a purely spurious correlation.
Correlation and causality and all of that. Of course.
Exactly. If you look at what the Fed said in the footnotes of the 86-page order, they were opening the question whether a bank that basically can pay any transaction fees to unknown validators. Okay, so essentially, could a bank be running an Ethereum node and paying gas to an unknown validator? This is where it's so interesting, because the Clinton administration, with the Berman Amendment, got it right. Basically, the way packets move across the internet is you really, until geolocation, geofencing came along, you couldn't control whether the packet went through a sanctioned country like Iran or North Korea, right? These are just nodes on the internet, and you couldn't control where it went. Okay, and so the Berman Amendment essentially said you aren't required to trace those packets to know whether they're going through friendly hands or whether they're going through unfriendly hands. But what the Fed just said in the footnotes is that you are required to, at least they are opening the question, to know who the validators are on your network. Okay, that basically blows up the whole concept of the internet. And at first, it's funny because I was. When we saw the January 3rd statement, anti-crypto statement from the three federal banking agencies, the FDIC, the OCC, and the Fed, and they talked about the heightened risks of using open, public, and/or decentralized networks. And at first, I thought, well, that's just sloppy drafting by lawyers. They should have said open, public, and/or decentralized blockchain networks. They didn't say that. They said open, public, and/or decentralized networks. Okay, what is TCP/IP? What is HTTP? They're
right.
Open, public, and/or decentralized networks. Okay, and at first I thought, well, this is just lawyers not talking to tech people. I'm trained as a lawyer, so I can fire that shot at my fellow legally trained minds that they generally don't understand how tech works. Okay, and so the concept of writing policy, which is of course mostly what lawyers in Washington D.C. It's mostly lawyers who are writing policy. You don't have a lot of tech people at the table, in my experience. And once you get the tech people at the table, then things start really changing, and you actually start to get really good policy. But I looked at that and thought, okay, well, there were no tech people at the table. I'm now not so sure about that, Tom.
Fair enough.
Because look at what happened with Silicon Valley Bank, and look at what they did with Signature and Silvergate, and some of the other tech forward banks are being harassed by regulators. I think that anti-tech wing has decided that either because the Fed's tech is so antiquated on the back end that they don't want the banks who have built all this custom software on the front end to make it look like it's a Ferrari engine on the front end, even though it's still integrating with horse and buggy on the back end. Mm-hmm. The middleware, I know one of the banks that went down, the CEO told me they spent 4 years building their middleware. Okay. I think that scared the powers that be in Washington, that you had banks that were operating, in the case of Silvergate and Signature, 24/7, 365 US dollar platforms. Yep. That you had to, but both sides to the transaction had to be customers of the bank. So it couldn't leave the bank. The money never left the bank until banking hours resumed. Okay. But you had far advanced tech. And the same thing is true of Silicon Valley Bank. It had APIs. Very few banks in the United States use APIs. What is an API? Application programming interface. This essentially allows you to use software, to write software to make payments. Okay, it's not unlike online banking, which is really just form fill. It's really just you're digitizing something that's analog. Once you get into the API world, it's native. You start to get closer to natively digital, and so things start moving a lot faster. Well, I mean, we all read the Wall Street Journal article about the Fed's wire room closing at 4 p.m. and that, they might have saved Silicon Valley Bank if the collateral had been able to move from the Federal Home Loan Bank to the Fed before 4 p.m., but the Fed needed to put a test trade through. Okay, so what is all that saying? That's saying we've got really antiquated back offices, and you've got these banks that are getting, whose tech is way far ahead of what's actually happening, in the back office. And that's scaring the powers that be. Now, here's the problem with that. Crypto is so far advanced, and especially the Gen Zers and millennials are, who have never set foot in a bank branch. They don't want the analog financial system, and they will use, because they're used to it, they will use the digital financial system. It's the Uberization of the financial system. The Taxi and Limousine Commission, which is the bank regulators, are not going to be able to stop this. And you and I both know right now on the Lightning Network, 8 billion people, if they know how to run the code, can download it and run it on their phones and create US dollars and transact in US dollars using Lightning. In other words, collateralized by Bitcoin. Okay, here's the punchline. That's the Eurodollar market in spades.
Yes, it is.
Why is the Fed not trying to bring this inside?
Okay. So again, as you just went through all that, which is brilliant and lovely and all of that. One of the things we haven't discussed in this system, in this podcast, which I think is the we're missing the one word that matters in all of this. It's not that the Fed is against Eurodollars per se. What the Fed is against is leveraged rehypothecated Eurodollars, which creates circulation dollars, not. So in this respect, if that's the case, I don't think the Fed cares if they push it into the shadows or even that Lightning Network is. It's clear that the Fed is behind the technology curve and they need to update their back end, i.e., that's what Fed now is, most likely. Or I haven't really.
We can come back and talk about that.
They need that they're trying to open up the back end in order to compete with what's happening in the real world. That's what they should be doing. So now the bigger question is, it's the leverage within the offshore dollar system that was created at the zero bound by Yellen and Bernanke, which I think was done on purpose. And other people can, vandalism or incompetence, you choose. I don't care. I'm on the side of they're all vandals because, well, it's kind of hard to argue that they're not, because they continue after they've been caught to continue to double down on the old behavior. If they
the old MMT philosophy,
these same arguments, right? So when I look at Yellen, I don't see a kindly old misguided grandma. I see the Joker, in Jewish grandmother clothes. That's what I see. It's not that hard. That's my personal bias. You can salt at the taste, but it's the leverage they want to get rid of, because it's the leverage that actually destroys the Fed's ability to control over monetary policy. As Daniel DiMartino Booth said the other day, is like, look, at the zero bound, the Fed doesn't need to exist. There is no Fed at the zero bound. As a matter of fact, when the Fed is easing, another way of putting it, my friend and partner Dexter White put it to, and we use this in a couple of newsletter issues, and I talked about it before, which is that when the Fed is easing and creating and allowing to create dollars, it's no different than any other Eurodollar creator. It's just creating credit dollars.
It's all credit. That's the point. Right. Yeah, exactly.
It's all credit dollars. Yep. So, but the Fed, so that's the flock of seagulls. That's the Fed acting like flock of seagulls. The real punk rock ability, the real superpower of the Fed is the ability to pull that back.
Yes.
So many people think, and this is where my Austrian brethren get it wrong. And I make the argument all the time. There are a lot of bad Austrian economists out there.
Sure.
And there are a lot of bad Austrian economists making commentary. Sorry. And Gary North used to make this point all the time too. It was like, there's a lot of guys who call themselves Austrians, but they suck. Like it's right. The old Calvinist.
Well, and then, but it just goes to show you, like, what is Austrian, right? What does it mean, right? Because I think the Paul Krugmans of the world look at it and say it's people who scream hyperinflation all the time, and they've been wrong, right? And
they have every right to criticize us that way.
Correct.
So when you think about where we are right now, the Fed having the ability to pull back on leverage by moving us off the zero bound, all it's doing is saying, look, we are a player at the table. And to Jeff Snyder's arguments about how the Eurodollar system has always wagged the monetary policy dog, fair point, but only if the Fed was a willing participant in the process.
Correct. Yeah, that's a great point.
But the Fed is not a willing participant in the process. I'm sorry, dude, but the Fed's the biggest Ponzi at the table, and everybody else is more vulnerable than they are. And whether you like it or not, look at me sideways, Obama. We're going 75 next month. It's just that simple. Like, and then all the other details that we've talked about, which are all absolutely part of this conversation.
Yeah. But now let's come back. So because you started early in this conversation by saying that one of the Fed's real mandate is to protect the banking system. And you just made the point that the Fed is the biggest Ponzi and it's going to suck in the other smaller Ponzi's, which are the fractional reserve banks. Okay. By definition, we all know
the offshore shadow banks is what they're targeting.
Well, but here's the problem, because they have run up against the fact that the banking system wasn't well capitalized enough to handle this. Okay. And up until this point, as every time we had the refi requirements in financial markets, we got $1 trillion of debt that has to be refied. For zombie companies, there's going to be massive defaults. Okay. Just is. It's a credit cycle, right? Yeah. We've now got the banks impaired because of their duration mismatch. before we even take into account the credit defaults. Okay. So now how do you square that circle? Because the community and regional banks are already essentially, if you mark to market their treasury bond exposures, they have very little equity left. And that's before we go into a default cycle.
Yeah, I don't know. I don't have a good answer for you other than to say that the money that is overseas has to come back this way. And the only way that cycle, and this is again a short-term, this is a short-term argument. This is in financial terms, a medium-term argument. This is a 12 to 18 to 24-month argument. Don't talk to me about what happens 10 years from now. If with what we're seeing de-dollarization wise, right? If the Fed does not create some kind of virtuous cycle to bring that money home, and if we don't see policy here at the political level to invest back in the United States, then no, what you're already seeing is the mother of all debt bomb, the mother of all credit, the default risk
debt deflations. Yeah,
right. Absolutely, no argument whatsoever.
Yep.
So, remember that, and also remember that the most famous Austrian economist Ron Paul always said that hyperinflation and hyperdeflation are the same side of two. It's the same.
Well, the currency collapses, right?
Yeah, the currency collapses. It's just whether or not you default or you don't. And the hyperinflationists Austrians are thinking politically, and the hyperdeflationists are thinking, practically. Plumbing, I mean, if you really want to like put it in broad terms. And I'm somewhere in the middle saying, look, I think that the Fed understands both of these risks and is trying to thread the needle. I don't know that they're going to be successful, but I can tell you that every move that they make to try and be successful will be countered, partly by vandals and by traders within the Biden administration and by other people. I'm going to bring something into you that you and I haven't had a chance to talk about. I have talked about in other places, which is the changeover in the Bank of Japan.
Yeah.
Now, if you really this is my thesis, right? The dollar reserve standard ended in 2008. So or with the beginning of QE1 with QE1, and then the coordinated central bank policy standard was birthed in September of 2011, which is the top of the gold bull market, when the central banks got together, issued a $500 billion slush fund, and then did round robin QE for 13 years.
Yes.
So it was the Bank of England, then the SNB, then the Fed, then the ECB, then the BOJ.
Pass the baton.
Turns,
correct.
Right?
Yeah.
And they did this, and they levered everything up at the zero bound.
Yep.
Who's the last bank that hasn't raised interest rates yet? Of those five.
Japan.
Yeah. So who is the beneficiary of, at this point in time, right now, if they're the most vulnerable of the five, who's the beneficiary of the Bank of Japan's continued yield curve control? The ECB. Because a short JGB yen carry trade is what can create, which is what can allow Lagarde to then maintain credit spreads and play the euro and play the euro game, play the euro and the credit spread game, which is what she's been doing. And by the way, she's been losing slowly but surely. At the same time, they've been trying to run a deflation trade on the oil markets to get Europe's cost of energy down and raise the euro back up so that they have enough freaking energy to get through next winter.
To get through winter.
The winter after that. And so what did OPEC Plus do? What did Putin and MBS do the other day? Hey, big fuck you, and said, nope, we're already cutting production into a market that is already a million barrels a day in arrears.
Yeah.
This is important because now
it is important.
Now we have cost push inflation on the one side coming back in, commodity inflation, credit deflation, and Ueda is going to, and we're already seeing it in the financial press, picked up on the point that I made, which is that when Kuroda left, Amaniya turned the job down. His right-hand man turned the job down. Okay. Now in Japan, this is a great honor to be given, to have the job passed to you.
Yeah.
And he's turned it down for the good of Japan.
Yeah.
And Ueda is going to come in, and I saw two articles in Bloomberg that the world is now worried about whether the Bank of Japan is going to give up yield curve control. And
yes,
I can tell you
that the market's firing shots at them, trying to force it, right?
And
same thing with the Hong Kong peg. Yeah.
And during and to validate all of this, during Silicon Valley Bank and Credit Suisse's, during that turmoil, what happened to the bank, to the JGB 10-year? It dropped in yield because you saw a massive carry trade on once, while the European Central Bank had to belly up to the Fed's foreign repo facility, FIMA, for $60 billion to get enough freaking collateral to keep the European banks from collapsing.
Right. Well, as
That all
Credit Suisse was
happened.
collapsing. Yeah.
And it all fits with the cross-border. So this is a mess that is still unwinding. And in the middle of it, and unfortunately, you and Custodia Bank are kind of caught in the middle while Titans are, stomping around and throwing lightning bolts at each other. That's the way I see it, Caitlin. And I don't know that I feel for you. I really do, because I think that what you guys are absolutely trying to do was to help bring rationality to our banking system.
Well, but also to ensure that the traditional system didn't blow up the crypto system, and the crypto system didn't blow up the traditional system.
Exactly.
Right.
Exactly.
I mean, we don't want either system to infect the other and cause problems. Right. I don't want that. I know there are some who want to burn down the traditional system, and because there's so much malinvestment, let's literally burn it down today. Yep. And I don't agree with that. I don't at all, because the deflationary depression that would ensue if that were to happen is something we should all fear. And so I actually think with Safety Amos that most likely the existing system will die, not with a bang, but with a whimper. And we should actually hope for that as people just vote with their feet to using the better, more stable system. But that's where we come back to, why did the Fed not want this all inside the regulatory perimeter and have it all inside M1 as opposed to in offshore M3 that it can't track? And again, we can't beat the dead horse. No one knows the answer to that. It will eventually become clear, I'm sure. But it's fascinating because you and I also talked about UBS and Credit Suisse. So some very interesting connections. I used to work in Paradeplatz in Zurich for the co-CEOs of Credit Suisse 20 years ago, back when Credit Suisse, it went from 90 to 19 and almost went bust then. Right. And one of the things that was fascinating, I was working for CSFB, the New York investment bank in the late 90s. And then this happened in 2001 during the tech stock bubble burst. They had an insurance subsidiary, not rocket science, why it went bust. It had 8 times the shareholders' equity invested in the stock market. So you have a 12.5% correction in the stock market. Back then it was a 20% correction. Lo and behold, the insurance company blew up. Okay. So I got helicoptered in, working directly for John Mack, who was then the CEO of CSFB, over to Credit Suisse. Okay. So that's my background. And they had me dual reporting on that restructuring project to the co-CEOs. So Ozzie Grubel, who subsequently became the CEO of UBS, a German. Okay. So you had an American and a German in charge of a Swiss bank. Yes. Okay. But here's the reason I laid all that out. Because I spent almost a year in Zurich working for those two guys and ended up friendly with both of them, which was hard to do. But what was fascinating, we had a successful restructuring, and the rest is history. And it all turned out just fine. Thank you in part to Greenspan having engineered a steep yield curve to bail out the banks. Okay, if that had not happened, would Credit Suisse have survived back then? Probably not. But here's where I'm going. Big buildup to, we knew back then that if Credit Suisse or UBS ever went down, it was going to be the Fed's problem. Why? Because the vast majority of the exposures on those global banks are US dollars. Okay. Now, you have made the point to me that Switzerland is different. It's not Europe. And from your perspective, it's okay that the Fed opened up the swap lines to help back up Switzerland, because these two Swiss banks are so much bigger. A lot of Swiss companies, frankly, are so much bigger than the Swiss economy. They're global. Why? Because of the Swiss private banking, right? But the Swiss National Bank is too small to bail out either one of the two big Swiss banks, Credit Suisse or UBS. And what we saw was UBS was given a credit line to bail out Credit Suisse. But where is that credit coming from? Is coming through the Fed. Okay. So we knew this all along. And you made a really interesting point that we should be happy about that. I don't agree with that, because if Americans understood that a foreign bank was being bailed out on the back of the US dollar, they would be horrified. But politically, we're not there yet. We got to come back and talk about Fed now in a minute, but fire away on swap lines first.
Just to put the color on all of this, I view the attack on Credit Suisse, especially with the rise of the $275 billion AT1 contingency convertible bond market, which is these reverse poison pills. I talked to Pascal Nachati the other day, and he wanted to talk about his lawsuit again that he filed with the U.S. With the New York Supreme Court. But before we got and I talked to Pascal and I said we need to do an entire podcast on this. And I asked him about Credit Suisse. And this is a guy, he told me, he's like, look, I tried to buy Credit Suisse 5 years ago. Like, okay. So this is a guy who knows the situation. And he was very black-pilled about the whole thing. And I said, look, I said, the AT1 convertible bond market was a reverse poison pill for Credit Suisse and or for anybody who bought Credit Suisse. Because during a bank run, you're going to have a massive collapse of the market cap. These bonds are going to be converted at par into shares in the company. If you lower the market cap, you raise the percentage.
And you lose control of the acquirer.
Right. Yeah. And so so who do you think owns all this stuff? It's the very people who ran the bank run on Credit Suisse in the first place. Not to say that Credit Suisse didn't put itself in that position or anything else. But if you are the Fed and you need to have it's like I've said before, if Tether, just again, go with me on this. If Tether is the means by which Bitcoin stays liquid without trading in real dollars, then Credit Suisse is the main mechanism, and in UBS, the main mechanism for the Swiss National Bank to keep American stocks and US dollars liquid in Europe, but under the auspice of the Fed, as opposed to under the auspice of the ECB and the City of London. Remember, this is the difference. And when the first time Credit Suisse came under attack, it's contemporaneous, but it matters. It was last July August, the same week that the Queen Elizabeth dies. Liz Truss is thrown out of office, and Rishi Sunak is forced into office. Like Davos destroyed Brexit, then got monetary control back and political control back over England. They want and they have political control over the Swiss because the Swiss president is the guy who violated Swiss neutrality for Klaus Schwab over Ukraine. This is a big, the politics here is very important. So of course it makes sense that the way I'm viewing all of this now is that Davos goes after both political and monetary control of the country. If they have both, then they can implement policy. But if they don't have one or the either, they're in trouble. So they either rig an election to get political control, or they get control of the central bank. And they have political control over Switzerland, but they don't have control over the Swiss National Bank.
Yeah. See, I'm not sure I go that far, but I'm listening. Okay, keep going.
But even though, as Pascal pointed out to me, the Swiss National Bank is a quote wholly owned subsidiary of the Bundesbank. Here's the kicker about what happened with Credit Suisse and UBS. Yes, we all heard the top line thing because Davos was pissed off that the AT1 cocoa bonds were written down to zero and the shareholders were put in front of them. They were all angry about that. But here's the thing. No one noticed this. Even Zero Hedge, which reported on it, missed the important point. The ECB and the European Bank and the EU were not consulted on the deal, but the Fed was intimately involved in this. So, and when I told Pascal Nechati that, he stood back and he went, and you could see him recalculating in real time. Like all of a sudden, that was discontinuous to him. He didn't know that because he was distracted with other things. Yeah. And so it was that.
And again, because Credit Suisse was such a big US dollar bank, right? Credit Suisse is a primary dealer. This is the first time a primary dealer that issues treasuries went down, right? It's the first merger of a GSIB. By the way, Colin Kelleher, who's the chairman of UBS, and in Switzerland, the chairman are really the guys in charge. Right. He's who hired me at Morgan Stanley. So it's fun to watch because Colin is just a no BS guy. And it was fun to watch his press conference. And he just was on fire.
Yeah, no. So to me, this just looked like a defense of the American dollar markets and the Fed and our own financial markets, even though we had to go and effectively help bail out or at least help, restructure a Swiss bank. But this is a Swiss bank that is, as you pointed out, a GSIB for the US dollar markets. And politically, this is, and of course, like whenever you look at these things and you start flow charting this stuff out, when you control and when you're talking about people who control the media, what do you think they're doing? You don't think that they haven't gone through the whiteboard of the flow chart and go, well, this is how we win. If we lose on this, then we hammer that point, and then you see it in real time.
It's so interesting, Tom, because here's my experience with what you're saying. It's plausible, but part of the reason why I'm skeptical that it is that orchestrated is I've just been around these folks and I just don't think it's that orchestrated.
It may not be, but to me, it's like it's so clear that the full court press is on right now to undermine what's left of the institutions of the United States.
Oh, that's
political,
clear.
legal, that all of this makes perfect sense,
Correct.
and you have to take out in any way that you take out the Fed. So the way I look at it is again, it may be contemporaneous, maybe correlation does not necessarily imply causality. My left brain may be firing off ridiculous threat assessments that aren't real, but the Fed takes out Silicon Valley Bank, Signature Bank, and Silvergate in a week, and the next week Credit Suisse is in trouble. Yep. And someone's running a whisper campaign over the weekend about pulling their money out of Credit Suisse. This shit is not uncoordinated because whisper campaigns are designed to create bank runs, and the people who were doing it came right out of the usual freaking suspects. But
here's the thing. Those banks were unstable to begin with.
Of course they were.
And because they were all running small p Ponzi schemes. Okay.
I agree.
None of them were solvent.
I know that.
Right. And
that's why it makes it obvious that they went after the most vulnerable one.
Well, yeah, I'm not so sure about that.
Went after Silicon Valley Bank, which is the most vulnerable of these onshore shadow banks. So Davos responds by going after the most vulnerable and systemically important.
Yeah. Well, but see, I do think that they did go after the crypto banks first for a reason. Again, this comes back to the technology piece, right? They don't want especially the smaller banks that are very tech forward. So we already covered that ground, but I mean, there are some very interesting questions that I hope come to light, and I believe they will come to light on the signature situation. When the FDIC takes over a bank, they typically take it over, frankly, always take it over at 5 p.m. on a Friday. Yes, and signature got handed to the FDIC on a Sunday afternoon. Okay. Yeah. And Barney Frank came out and said, we were solvent. We were going to be fine the next day. If Signature had been allowed to open with the BTFP, it would have been fine the next day, right? So why did they take it down, right? There's some very legitimate questions that I don't have answers to.
It fits in with it fits in with my argument that the Fed took it down on purpose and wasn't going to allow it to get out of the box. So you do take it.
Well, but why? Why again? It's an anti-crypto move. Why? They should be wanting to keep all this stuff within the regulatory perimeter so that they can control it.
But from what I understand about Silicon Valley Bank, and I don't know as much about Signature, but what I understand about Silicon Valley Bank was that most of what was on what they were doing was Silicon Valley Bank for its size wasn't a CFI, even though it should have been.
Correct. Yeah.
And they lobbied very hard in Washington to not be a CFI. And Janet Yellen and Gary Gensler and all the rest of not Gary Gensler, but certainly Yellen and others allowed it to happen. Why? Because they were engaging in hinky shit that the Fed was not happy with. So, but
the Fed had the ability to
be
shut
more complicated than that for me. I'm not a lawyer. I'm just some guy, and I'm just some asshole on the internet with an opinion. So
here's what was fun for someone who has been engaging with the bank regulatory process, to hear the testimony that the bank regulators were warning about the problems at Silicon Valley Bank. That tells me that it's the higher ups at the Fed that shoved it under the rug. It was not the people on the ground. People on the ground were doing their job and were warning, but it was the higher ups that seemed to have screwed up.
Was it happening at the San Francisco Fed?
Don't know. That should come out.
When we talk about the Fed, as opposed to talking about the San Francisco Fed versus the Dallas Fed, because it tracked completely that the San Francisco Fed, and remember, and this is the point that Daniel Booth makes all the time, like the Fed's not a monolith. The 12 banks operate independently for the most part, under the auspice of the FOMC and the Fed Board of Governors. But, as far as the regional bank regulation is for the most part handled by the regional banks. And back to the San Francisco Fed's been a problem for a long time now. And, and again, because this is an ugly transition period. One of the things that things are ugly. As a chemist, like I always like to describe it this way. We all learn these basic reactions: sodium plus chloride minus equals creates sodium chloride. But no one ever talks about that transition state that is implied by the arrow, which is the reorganization of the molecules, especially in complex chemistry like organic chemistry. You have to respond and you have to move things around. They're not just Lincoln Logs or Tinker Toys that fit together. You got to move stuff around in order to get it to happen. You've almost got to put energy in to get the energy back out again. It's called the transition state. The transition states are messy. There's going to be a lot of information and a lot of actions taken by people during transition states that will seem discontinuous.
Right.
And that not every,
they may be discontinuous.
Not every action that Powell takes, for example, is going to be supportive of a particular thesis, or every statement that Jamie Dimon makes is going to be supportive of a particular thesis. You've got to look at the totality of their actions. Again, this is not to undermine anything that you've said here. It's just to remind everybody that, we're all doing our best trying to make, sense of this. And sometimes there is no good sense. It's just, this is the best. Everybody's making the best of a bad situation.
Yeah.
And
let's throw in
mistakes too.
But again, maybe they don't really know, because they don't have a strong philosophy. They don't really know what they're doing. They're just rolling with it.
Yeah.
We don't know, right? We don't know.
Right.
But let's throw in FedNow, because that's become a topic. Balaji attacked FedNow as a CBDC, and now we have Robert F. Kennedy Jr. announcing that he's running for president against Biden and coming out strong against the CBDC. And his tweet yesterday got, last I looked, almost 7 million views. Okay, this is not a small number of views on Twitter. Okay, right. So this is starting to take off. And this notion that FedNow is surveillance coin and a CBDC, I reject that. It's not. However, it's not wrong that there will be more surveillance on digital dollars relative to cash. Sure. And it's also not wrong that this is really not a private sector payment rail, right? No. And so arguably, because it's taken the Fed so long to get FedNow where it is, and in the intervening period, we had all these crypto rails pop up that proved that they have scalability, that proved that people use them for real world transactions, not just for trading. Okay, so right. but they're now trying to kill those private stable coins. Okay, so I get why the conspiracy theorists are speaking out against FedNow. My bigger point about FedNow is a simple plumbing one. Can you imagine if we'd been through Silicon Valley weekend when FedNow had been introduced? The amount of movement of bank deposits over that weekend would have been staggering. The rumors that can now move bank deposits at the speed of light with combining online banking and APIs and Twitter, right? Banks need to be far better capitalized, i.e. far less leveraged, and they need to be far more liquid. They need to be sitting in cash. And last I looked, the aggregate small banks had only 6 cents on their deposits sitting in cash, and the GSIBs had only 10. Yeah. Okay. So, but by the way, all of this has been true all along. Just because the world has suddenly woken up to it doesn't mean that it hasn't been true all along. And right. Those of us who've been watching the banking system knew all this all along. It's fundamentally unstable. But over to you.
No, what I was going to say is this is something that Dexter White and I have talked about behind the scenes, which is that he's been complaining, like, why do we need to have 24/7, 365 bank settlement? Like it's actually, we don't absolutely, the world isn't going to end if a lot of people have to go net 10 or net 15 or net 30 on there, meaning that for certain things, and that was his argument. And I'm not saying he's right or wrong.
We're going there.
Because you just made a very, very good point, which is that, no, actually, by leaving this old antiquated settlement system in place, you're actually allowing the banks to run higher leverage against their balance sheets than they should be. So therefore, their leverage should be. So maybe they're going to have to bring leverage down. They're going to have to bring liquidity up. They're going to have to sit on a lot more cash. Period. And that's a good thing.
I agree. Absolutely.
That's a fundamentally good thing. So, and from that
stability of the system. Yes.
Yeah. No. And the problem here is, here's when I go into political schizo posting. Ready? The Fed will be the biggest talking point, and it will be the biggest platform point for the Democrats in the 2024 election cycle. Powell is going to engineer. Okay, I'll explain. Powell is going to engineer a recession. Elizabeth Warren is going to be out there screaming, Powell stole your job by raising interest rates. You can't get a car loan because of this. You can't afford a home. Yeah. Blah, 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 blah. Their goal is to end the Fed. They want the Fed gone. They want to subsume. If they can't control the Fed, they need to subsume it back under the Treasury. They need to get rid of it. If the commies want to win, they need to get rid of. If they can't control the central bank, then they need to morph the central bank into the Treasury Department. And to Daniel DiMartino's booth point, which is when the Fed's at the zero bound, the Treasury is the central bank.
Yes.
Which is what Yellen has been arguing for the entire time, and the policy that she has pursued, and all of the shenanigans at the San Francisco Fed under her watch and later all support this idea. So they're going to go after, they're going to run on end the Fed. And do you know who's going to be their useful idiots? Every screaming dick fucking libertarian out there right now screaming end the Fed. And they're all goddamn wrong. And you're like playing right into their hands, dudes. Like the Fed is wrong at a fundamental level. I don't believe in central banking. I'm not arguing for it or against it at this point. I'm saying, look, this is their plan. And if you don't want to be the useful, stop carrying water for people you hate. It's not that tough. Understand that as bad as the Fed is, and to your point, as bad as everything we've discussed in this podcast tells us that the Fed has a lot of challenges in front of it, not the least of which is allowing for a project like yours to become a part of the solution of where we go in the future. But as of right now, the Fed is under unprecedented attack and is being railroaded politically into a situation where it could lose everything while it's trying to regain its lost credibility, thanks to the vandals of Bernanke and Yellen and the mistake and the personal faults of a guy like Greenspan. Like,
but keep in mind that they made a fundamental mistake, which is assuming that they could raise interest rates as fast as they did without impairing the banking system.
No, I don't.
Should have been obvious.
I don't think that is. I think that was a purposeful mistake. I'm with Daniel Booth on this. I think they did it on purpose. You
think they want to bankrupt banks?
I think they needed to raise interest rates very, very quickly
that's clear.
They had to break something very quickly, because I think they're also looking at the situation, which is the neocons want to go to World War III. Yeah. These people want to take us to World War III and finance it through leverage and debt and all the rest of it. And the way you slow that process down is you raise interest rates very, very quickly, and you wring egregious leverage out of the system as quickly as possible. And there's going to have to be some amount of damage along the way. And I think that, and again, I don't know that they have all, this stuff better than I do. And this is why I love talking to you today, because, but I look at it strictly from a qualitative, strategic counter move perspective. And I say the Fed is clearly making strategic moves to shore up their position and to try and shore up the American banking system relative to the rest of the world.
But they should have been telling the banks to go raise capital. They should have been, and instead they were allowing the GSIBs to buy back stock, right?
Yeah.
So, I mean, there's a data point that suggests that maybe this isn't as all orchestrated as or
they don't have as much control over this as possible as we think they do, or anything. I agree. I mean, I don't have good answers for all of it. I wish I did. I'm just,
because ultimately, back to your point about what's the Fed's raison d'etre, right? People talk about the dual mandate. From the very beginning of this podcast, you pointed out that it's to save the banking system, right?
Yes.
Okay, so that's actually
it's to regulate. It's to maintain the banking system, the U.S.'s banking system. That's who they work for. They work for the U.S. banks. Ultimately.
Well, because again, as we pointed out, the structure is that the regional reserve banks are owned by their member banks, and the CEO of Silicon Valley Bank was one of the directors of the San Francisco Fed. Right. Mm-hmm. Okay, but so now how do you square that circle? Because they cannot raise interest rates high enough and keep the banking system solvent.
Not without a fresh injection of capital. And the question then becomes,
was that Powell's mistake?
Maybe. Or is that fresh injection of capital going to come from overseas? As the other markets break and we taper the Ponzi and all that cash that we talked about at the beginning of this podcast starts coming back over here. And what we're seeing right now, what we're arguing about right now, is that we haven't seen it yet, because Lagarde and company still have enough pieces on the board to keep capital markets in Europe from imploding. But imagine what happens when the euro goes back to parity and the German 10-year Bund is trading at the same rate as the American 10-year Bund. Do you really think that Europe is going to be solvent? No, that's your big signal that the whole thing is collapsing. And then all that money is going to flow over here. So the goal is by Davos has always been to continue to press the idea publicly in the minds of market analysts and market participants and investors that the United States is descending into anarchy and clown show. So, because why would you want to put your money in a clown show? Keep it in failing Europe.
Yeah.
Keep it in fail. Okay, that's the key. So when Ueda turns in at the Bank of Japan and gets rid of yield curve control and knocks out the last friggin' pillar of Lagarde's money laundering system that's clear as day on the friggin' TIC report.
Yes.
The Eurozone's been buying treasuries, been a net buyer of treasuries while everybody else is getting rid of them.
Correct.
To defend the euro. So mud on the me. I keep seeing this and I'm like, it's so very obvious. And once that collapses, that's when we're going to see, I think we'll see the massive, as Martin Armstrong has always put it, the massive capital inflow into the United States.
Yeah. Well, that is happening. Yeah.
And the debt ceiling, and Yellen's last stand will be the debt ceiling fight. And if she loses that fight to Matt Gaetz and Wall Street,
so how do you predict that that's going to play out?
I think that I don't predict anything, but what I'm saying at this point is the highest probability outcome is that Jamie Dimon et al. Put the pressure on Kevin McCarthy to say, you back Matt Gaetz or that we're going to cut spending and we're going to signal to global financial markets that the American government is going to cut spending, service the debt at these levels, and but if necessary, raise the debt ceiling to keep Yellen from being able to dump $1 trillion in short-term T-bills on the market and force the Fed to cut rates. Like that's what Boots' worry is, and she's absolutely right. But I think that if the debt ceiling fight is resolved quickly, and the Biden budget is not only rejected, but we say, oh no, we're cutting 10% from the big guy, as opposed to allowing the big guy to get his 10%. I think if we just start that process, I think the global financial markets will reward us handsomely for that for us, any kind of statement of fiscal restraint on the part of the United States, and then Powell can stop raising rates.
Well, so this is going to be so interesting because the Treasury General account is down to 140 billion. What is that telling you? It's actually coming faster than people think. Okay. Yes. And there has not been any real conversation happening between the Republicans and the Democrats and the Biden administration. Yeah.
I know.
Yeah. So it's an ugly situation. Yeah.
I know. But they're consumed now with Donald Trump and, more irrelevancies.
Well, that's bread and circuses trying, look over here. We're gaslighting you over here when, where we should really be focused is on the serious issues, and very little attention is being paid to those. Yeah,
I agree. But at the same time, what does Donald Trump's indictment represent? It represents a gross violation of the rule of law, of everything that we hold as the vestiges of the myth of America, as a place where, and this is very important. Symbolically, this is very important. And it's narrative and symbology that we're dealing with. We're at this point. And not the raw plumbing numbers. I mean, the plumbing numbers are terrible. Don't get me wrong. I'm not saying that, but I'm talking about politically and in the sweep of history where we are at this moment in time over the course of the next 3 to 5 to 7 years. How are we going to get out of this if we don't admit that, if we allow these people to burn down our faith in all our institutions?
Yeah. Well, so that's so interesting because as you know, I spoke out against Trump for his view on Bitcoin. And again, back to what we were talking about earlier, that there are anti-crypto and pro-crypto factions within the Biden administration, same thing within the Trump administration. And Mnuchin was his anti-crypto faction. And in the Trump administration, he's the one who got Trump to be anti-Bitcoin. And it just, he didn't get it. He didn't understand that, that was, he didn't see it for what it was.
And I've talked, and I know I've talked to another, and we've been going.
We should probably. I know we're
I know this has been. Don't get me wrong. This has been great, and I'm
back and forth because we don't agree on everything, but we help each other. We push each other. I like that.
Brilliant. But all I'm going to say is, and I haven't brought in the final answer to all of this, which is that if we get political control of the United States and wrest it back from foreign control, which is a very big if, people.
Yeah.
And 60-point type, bold, italic, underline, the whole 9 yards. Then there's the possibility of capitalization through the remonetization of gold. and or Bitcoin,
Mm.
and which is the longer term strategy to get out of this. And in the interim, it's going to be ugly. And I don't want to, I've talked about this at length in other podcasts and other interviews. And I know that you've probably, heard me talk about, or at least we've talked about it a little bit. I just wanted to make sure that we leave this with there is a path out of this, or at least one or two paths out of this. And there are clearly people in positions of power who understand what those paths are. The question is whether they're going to be able to pull that off or not. That is the big open question in my mind.
Yeah.
I don't know.
Yeah.
So,
well,
and maybe at some point that they're going to be on your side with Custodia Bank, FYI. I just think it's going to be a few years.
Well, because there are a lot of people who understood we were friendly and who really did see and respect the view that we shared, which is we do not want either of these two systems to collapse the other. And they do need to be developed side by side in a careful manner, and you can comply with the anti-money laundering and counter financing of terrorism laws. You're actually much more likely to be able to comply with them if it's inside the regulatory perimeter. Maybe this is a good way to close. I tweeted out yesterday that one of the interesting things that the Biden White House, the anti-crypto faction, which is in control right now, they're getting wrong is the polar opposite of what the Clinton administration got right about the internet. And we were talking about this earlier, basically the Berman Amendment. You were allowed to operate the internet, even if the packet of information went through a sanctioned country. That didn't stop you from being able to use the internet. Yes. And so what's happening is that the authoritarian instincts in that anti-crypto, anti-tech wing wants to close the United States off. And here's the great irony. If you follow what the Clinton administration did well, they essentially created incentives for people to stay in lit markets, right? We had the Netscape browser back then. People didn't have to use the command line interface to use the internet. Excuse me. Some people knew exactly how to do that, and they're free to use the command line interface today. Why do most people not browse the internet using the command line interface? Because it's crappy user experience. Why do most people not make phone calls on voice over internet protocol through the command line interface and instead use one of their telco providers? Better user experience and basically better security. You're outsourcing your security, as imperfect as it is, to somebody who's going to at least put a shield between you and the dark web illicit finance elements. Okay. So what's the best way? The optimal way to get compliance with anti-money laundering, counterterrorism financing laws, it's to bring it inside the regulatory perimeter and create an incentive for people to do business there. Most people will do business there. Most people don't run their own servers to access the internet. They use an ISP, an internet service provider. Most people use a telco to make phone calls rather than making phone calls on, voice over internet.
Most people don't run a Lightning node to transact Bitcoin.
Right.
Even then, right? I mean, even though Lightning is running, even though they may use Lightning, they don't run their own node.
And ultimately, because of the way Lightning works, most of the liquidity is going to go through lit channels because they're going to be intermediaries, and that's okay. Because from the libertarian perspective, because Tor exists, right? Because Lightning, you can go peer-to-peer on Lightning instead of routing your payments through a lit market. Okay. This is the way that the internet succeeded. This is the way the US did it right under Clinton, and they're not doing it right under Biden. And I'm not sure that had Trump been elected, they would have done it right under Trump either, because the neocons, of course, like to think everyone's a terrorist until proven otherwise, right? And this is why the Patriot Act and travel rule ended up coming in under Republicans, right? Yes. So my point is, I think that I'm hoping that cooler heads prevail and that folks wake up and realize that crypto's not going away, especially Bitcoin. It is the right way from controlling against human trafficking and child porn and the things that all of us agree we should shut down. The right way to handle that is to create incentives for people to go through lit markets. And then you hire a lot of law enforcement people to watch the dark net. And that's how you go after people who are violating property rights and human trafficking on the internet. That's how the internet was done in the 90s. That's what Clinton did well. It's frankly, I think his biggest and best legacy is he let the internet develop in this way. And the Biden White House, unfortunately, is going in the opposite direction. But let's hope cooler heads prevail. The good news is it's code, right? And all 8 billion people on this planet Earth can download that code right now if they want to, and they know how to operate it and start transacting in US dollars. It's just a question of when, not if.
Yeah, no, I agree. And it's a brilliant way to end all of this. I have to say, I wasn't sure how this was going to go this morning.
Me neither.
And which was good. I rarely feel that way when I'm sitting down to have a podcast with somebody. I usually kind of know where we're going to go, and I'm glad we did this morning because I learned a lot, as always.
Me too.
And
me too. Thanks, Tom. I really appreciate it. We went way long, but I
I'm not going to complain. I don't know. Maybe I'll cut this up into two episodes, or I don't know. Probably not. I'll just throw it out there as one big thing and let people deal with it because I don't optimize the monetization of my podcast. Certainly, it's more about the ideas and the
ideas. Exactly. But that's why I respect you so much, because I don't agree with, and I know you don't agree with all of my ideas either, but that's what's fun, is that we respect each other enough to talk about them in a respectful way.
Right. Absolutely. Because look, we what are you going to say? Like I'm omnipotent. I know everything. Of course I don't. Like, again, just some dude on the internet doing my thing and
but
seeing
boy,
what I see.
Helped me think. Yeah.
Right, and the goal is to get people who have better experience, have them go, yeah, no, you're right about this, but you're wrong about that. Oh, great. Really? And I'm, for those of you who can't see,
that's how you learn.
Like sitting here going,
I love it. I love it.
So it's all good.
I mean, one of the greatest things in life is continuous learning, continuing to be a curious person, because none of us knows how this is all going to turn out. The future is impossible to predict, especially the timing. And we're all just trying to figure it all out. I think if you're listening to this podcast, intuitively, something's wrong. Right. And you just don't know exactly how it's all going to play out. And, I think you and I are both humble enough to admit that we can't predict exactly how it's going to play out, and certainly when.
Yeah, certainly when. Caitlin Long,
thank you.
It's been an absolute blast, and we will try and do this again sooner than 3 years when our schedules permit. So
much appreciated.
I'm sure there will be nothing to talk about the next time.
No, nothing at all.
All right.
Take care.
Love. You have
Thanks,
a great
Tom.
weekend.
You too. Bye-bye.
Well, that'll about wrap it up for episode 138 of the Gold, Goats, and Guns podcast. I want to thank Caitlin for her time and diligence and expertise across so many matters that, honestly, I learned a lot, and I always love when that happens. So we'll be back soon with another one. Whenever the spirit moves. So you guys be well. You take care. We'll talk soon. Keep your sick on, guys.